Now, I welcome you today for today's session, where we are going to be looking on our last topic, where we are going to be discussing about the international financial derivatives. And I remember during our last class, I was able to do an introduction in regards to what in an international financial derivatives. And we said these are just the financial instruments. A minute. So we are discussing about the financial derivatives, and we say that they are financial instruments where the value is derived from one or more basic variables, which are normally known as an underlined or the assets. And we know very well that we are going to be dealing with the assets. And the types of derivatives that we are going to be dealing with under this topic, we are going to be basing our arguments under the forward contracts. We are going to be coming up with the future contracts. We are going to be having options, and then we are going to be discussing about swaps. I know very well these are not they are not unfamiliar names. These are the names that we have had, and we have been scared there before that it is a difficult topic, but it is not. Considering that it basically follows under the how you understanding the setup of the questions. When we discuss about the future contracts, it means we are analyzing the money market, and it means that we are going to be learning more in regards to the first two. That is why I was able to start with the forward and the future contract. These are the money markets as per the examiner requirements in most of your past papers. And when you are going to be analyzing the future contract, which are our money market, we are saying it is a legal agreement to buy. You're going to be able to buy or sell something. It is not something, but we can be able to discuss about an asset at a predetermined price at a specified time in future. It means that it basically follows the concept of the time value for money because we have to be determining how much amount I'm going to be borrowing the next 3 months or any month that is basically derived by the type of the contract you are engaging in. When you look on the forward contracts, we are just saying it is a customized contract between two parties to buy or sell an asset at a specified future time at an agreed price. You see here, it means that when you are going to be looking on because here, in both cases, you are going to be dealing with money. And because you are dealing with money, it basically put you on a point where you have to be defining what is the role of the bank. And basically, you have to be defining those roles as you move on and also being able to sort out your problems in a question. Now, I just want to be able to understand that the forward contracts normally involve the right or an obligation to either buy or sell a given number of assets. I have said that the forward contracts involves buying or the rights and obligation to either buy or sell a given number of assets that are to foreign countries at a predetermined exchange rate. And that is where we are discussing about the forward. So it means that when you're going to be analyzing these two contracts, because they normally have some certain analysis where we have to be looking on the differences between the two. But basically, when you look on the analysis that you are going to be looking at, it means that when you talk about, let me talk about LB here. And I'm talking about the future contracts. Let me start with the future contract. And I'm saying that it is where the trader, right, is required. The trader is required, right, to borrow. The trader is required to borrow from a financial institution. It is required to borrow from a financial institution and invest during the contract period. So it means that we are going to be given an obligation, right? Whereby we have to be borrowing and investing during the contract period, where the period is normally given within the 3 months or the 6 months. It depends on the type of the contract in which you are entering in. But when you look on the forward contracts, right? Forward contracts, When you look on the forward contracts, it involves, right, both right and obligation. It involves both right and obligation to either buy or sell, a given number of assets, right? A given number of assets to foreign countries, at a predetermined price. And when you talk about the foreign countries, because the contracts in which you are engaging yourself in, it means it is not just within the counties. Unajua watu hapa Kenya, we normally talk about nikienda county fulani mimi niko international. No, it means that we are going to be analyzing our concepts in the international treaties, where we are going to be looking between the two countries based on the agreement which is being put in place. And also, we are going to be looking on the currency, how strong the currencies are. We know basically most of the countries today, they normally like to use the US dollars, right? Unasikia kila mtu ako na US dollar. You normally have dollars, which we basically use mostly in trading. But it does not mean that the dollar is the most, it does not mean the dollar is the most expensive coins, or it is not the or the only expensive it is not the only expensive concept or the product which is the sorry. It does not mean that the dollar is the strongest currency in the world. No, it means that it is the most applicable and available. It is the only available in most of the countries in the world, and basically that is where you normally find most of the businesses they like or they prefer to use them. Now, there is only one thing that I just want to check on this. There is something called hedging techniques. Hedging techniques, right? Let's look here, the hedging techniques. Right? How are we going to be able to use those forward and the forward and the future contracts when we are doing an illustration and a question? And I will be able to start with an illustration here. Let me start with an illustration so that we can be able, or I can be able to analyze the hedging techniques. I can say Tabitha, right? Tabitha expects to receive Tabitha expects to receive US dollars 1 million. You expect to receive US dollar 1 million in 3 months' time. In 3 months' time. So in this case, the examiner is going to be giving you, when we are looking, this is a contract which we are dealing within the 3 months period, and the examiner is going to be giving you 3 months forwards, 3 months forward exchange rates, 3 forward exchange rate. And in this case, the exchange rate that is going to be given here, it means we are going to be given 100 to 101, right? Kenya shillings per US dollar. The only thing that I'm going to be looking at it here, I just want to teach you one thing. When I come across this kind of a question, I'm just going to be explaining two concepts under these kind of quotations given by the examiner. One, I just want to tell you, right? I just want to tell you one thing, right? The question that I have placed down up here, this is a direct quotation. It is a direct quotation. And for this kind of a quotation, Bank buys low. Bank buys low and sells high. And sells high in order to make profit. In order to make profit. I know Tabitha is able to ask herself that why are we saying is a direct quotation, right? And how is the bank going to be buying low and what are they going to be buying? Basically, here we are analyzing currencies. And the bank is going to be buying low, right? And is going to be able to sell those currencies at a high price so that they can be able to make a profit. Now, in that case, we are discussing about direct quotation. But what about indirect quotation? Let me give a difference. Indirect quotation, and I say the foreign currency amount needed to buy 1 unit of home currency will be given, right? The amount of foreign currency needed to purchase a home currency required to buy or to purchase a home currency is given, right? So it means when you are doing these questions, sometimes it's good to understand the recipient. Hako kona gani ya inchi? Is the question being analyzed? Because when you see, the question that we are discussing about is the receipts, right? Tabitha is going to be receiving some money, US dollar, 1 million. I know now Tabitha akapata hii pesa, shule ameacha. Now, in this case, sometimes you're going to be doing an analysis and we say, let us assume Tabitha is in Kenya, right? Tabitha is in Kenya, right? We just do an assumption that Tabitha is existing in Kenya. Now, in this case, because already we have analyzed that in direct quotation, the amount of the foreign currency needed to purchase a home currency is going to be given. The most aspect is basically to understand how am I going to be hedging as per my question here. Because already I was able to define these as receipts, right? These are receipts. And we are being given a 3-month forward exchange rate. And where we have said a forward exchange rate or a forward contract is where you are given a right and obligation to buy or sell an asset at a predetermined price during the contract period. Now, in this case, it is good, for instance, to understand what is the role of the bank in our question there. So you just come here, you say, let us define the role of bank. And this is very important, by the way, when you're going to be doing any question in regards to forwards and the money markets. Most importantly, you need to be defining what is the role of the bank in your question. And in this case, we say, because already we have to be defining, we say that Tabitha is existing in Kenya, right? So the most important, before even I analyze what is the role of the bank, let me define because these are US dollar, we want to determine Tabitha yatapokea pesa ngapi. We have been given the exchange rate 100 to 101. Unakujanga unaandika hapa 100 to 101 Kenya shillings per US dollars, right? We have said Tabitha is in Kenya, right? Tabitha is in Kenya. When you see your currency is normally arranged like this in any question, and you have already defined Tabitha Kwapi, for instance, right? Tabitha Kwapi. So it is very key to be able to do, ukiona Kenya shillings is there, you see, iko hapa. It means that this automatically becomes your buy, and this becomes the amount to sell. When your Kenya shillings is existing here. I know that Tabitha is asking, what if it is on the other side? Because you can see we are talking about 100 Kenya shillings per US dollar. What if it is on the other side? If Kenya shillings go on the other side, if US dollar, for instance, if US dollar was our home currency, then this figure could be buy and this is sell. So you normally do like this, like this. Where is my home currency? Is here. Nafanya kwa mkono namna hii. So if that is the case now, the most aspect is to understand where's my home currency. We have said is here, then this becomes your buy, this becomes your sell. If Kenya shillings on the other side, this becomes your buy, this becomes your sell. That is the most aspect. So when you go to the definition of the bank, you have to be analyzing about what am I doing? I'm receiving, and I will be able to say bank will buy US dollars. US dollars. Bank will buy US dollars. Bank will be able to buy our US dollars. So that is very key. So in this aspect, because the bank will be able to buy, let us now interpret and be able to solve our question. I will say $1 is equivalent to 100 Kenya shillings. You ask yourself, what about 1 million US dollars? Zitakuwa pesa ngapi hapa nchini? So you just say, I'm going to be taking 1 million times 100 and divide by 1, where you are going to be getting Kenya shillings. This is equivalent to 100 million. That is equivalent to 100 million, right? So those are the things that I know you're going to be analyzing. Now, the most aspect that the most thing that I just want you to learn tonight, it is how am I going to be defining the roles of bank? Because I have talked about these receipts. What about the payment? So, because I don't want you to be struggling in any exam, let us define the role of bank. What is the role of the bank, right? Number one, we say for receipts, bank will always buy. Bank always buy. Then we're talking about number two, for payments. When you're doing any payments, bank will always sell. Bank always sell. Bank always sell. So the most aspect is to look on the question and I will be able to define, is it a receipt? Is it a payment? Those are the only things that I'm supposed to be mastering when I go to the exam. Because I know very well, for receipts, bank will buy. For payments, bank will be able to sell. Bank will be able to sell. So I just want us to go and do some illustration from our past paper, so that we can be able to define, how am I going to be using these two rules? How am I going to be using these two rules in any exam that is going to be set under the forward contrast? So let us go to the illustrations there. Let's go to the illustration down there. So we are discussing about 2017 November. Let us start from that point. So November 2017, question number 5B. Cecilia can read for us. Question 5. Na hii maswali inaletwa pale mwisho mwisho ndio ushtuke kabisa. So question number 5B. Someone reads.
Jefferies Limited is a company based in France where the euro is widely used. The company has recently imported raw materials from the USA and has been invoiced for US dollars $240,000 payable in 3 months' time. In addition, the company has exported finished goods to the US and Australia. The customer in the US has been invoiced for US dollars $69,000 payable in 3 months' time, and the Australian customer has been invoiced for Australian dollars ASD $395,000 payable in 4 months' time. The current spot and forward exchange rates are given as follows: US dollars and euros. The current money market interest rates per annum are given as follows: US lending and the borrowing 10% and 12% respectively. Australia lending 14%, borrowing 16%. France 11.5% lending, 13% borrowing. Required: show how the company can hedge its foreign exchange exposure using forward market cover to money market cover.
So when I look on the question is given clear marks. You are given 6 months for forward market cover. The money market you are given 6. Imagine hii swali peke yake can make you pass an exam. Now, there is one aspect that I just want you to understand. There is a matching principle. Kama Cecilia namdai, for instance, as per the question tumeambiwa vizuri, Jackie Limited is a company based in France. So unajua home currency ni France, where the euro is widely used. So the company has recently imported raw materials from the USA and has been invoiced US dollar to 40,000 payable in 3 months' time. In addition, the company has exported finished goods to the USA and Australia. But the customer in the USA has been invoiced for US dollar 69,000 payable in 3 months' time. There is a matching principle up to that point. Why? Because you can see the contract that you have engaged with the USA, where I'm supposed to be making a payment and also receiving a receipt, happens within a 3 months period of time. So how is this happening? Remember, umedaiwa 240 na customer in USA. Na kuna customer mwingine anakulipa 69,000 US dollar from USA. How can you do a matching principle? Badala ile pesa nipewe, zipewe ule mtu ananidai huko, right? Rather than now borrowing and doing all those kind of adjustments from a foreign country. So in this case, you normally do something called a matching principle. Let us go to a board so that I can be able to show you how you normally deal with this kind of a problem. Now, when I look on my concept here, right? The concept of a matching principle, it means to do a matching principle, this is what you're supposed to be analyzing and thinking about. So let us do a matching principle. What is a matching principle? There is a payment in which you have to be making of Kenya shillings, 240,000. Is it Kenya shillings? No. Then there is another one, right? There is a receipt that I'm supposed to be receiving within the same period of time, amounting to 69,000. How much am I supposed to be paying? Because kuna pesa nadai hapa. For example, Cecilia nadai 240, na mimi namdai 69. So a total, because already tunadaiana, mimi napaswa kuongezea pesa ngapi wakati ameniuzia something. So you talk about the payment, because the payment outweighs the receipts. So in this case, it means that you have to be paying 171,000 US dollar. You have to be paying 171,000 US dollar. The examiner is very wise. He has given you a 3-month forward contract or the forward exchange rate. Remember now, we are just doing the first part for the forward contracts to get our 6 months. And in this case, because the examiner has given me the 3 months forward contract, remember this is a payment. So if you want to define, for instance, the role of the bank, what is the role of the bank? Remember, we are dealing with the payments. I just say here that for payments, bank buys. Let me know the rate in which I'm going to be using, because the examiner has given me a 3-month forward contract, the forward exchange rate. I'm going to pay 0.95, right? The bank will always sell, sorry. The bank will always sell. That is what we have said here under the rules. So the examiner has given you the exchange rate is 0.9520, right? 0.9525. 0.9525. Here we are talking about US dollar per euro. So in this case, the most aspect here is to analyze which is our home country. Jackie Limited is a company that is based in France, where we were being told the euro is the widely used. So the euro is our home currency. That is our home currency. So in this case, to define, because nilikwambia the home currency ikiwa huku, hapa ndio buy, and then here is sell. You see very well I was able to identify and normally follow home currency iko wapi, tumeambiwa iko under the euro. So euro ikiwa huko mbali, this becomes buy, this is sell. Then you go back to your rule. For payment, the bank will always sell. So nakuja hapo unaniambia the bank will be able to sell at 95.20. The bank will be able to sell at 95.20. So it will be looking like this. 0.9520. We are talking about US dollar per euro. US dollar per euro. So in this case, it means $0.9520 is equivalent to 1 euro. So you ask yourself, how much do we want to change to our home currency? We are discussing about 171 US dollar is how much. Do your exchange rate. And just say is 171,000, then I divide by 0.9520. 0.9520. Who can give us our answer today? Who can give our answer today? 171,000, you divide by 0.9520. We are getting 179, right? It will be 179,622 euros. 622 euros. Any question? Any question? Remember, this one was a 3-month forward exchange rate. But in your question, there is another story which is continuing. I was able to finish up to the point where we say the customer in the USA has been invoiced US dollar 69,000. That is what we were able to conclude at that point. But we have been told also the Australian customer has been invoiced for Australian dollars 395,000 payable in 4 months time. Umemalizana 3 months. Hiyo tumemalizana nayo because it was a business between the France and USA. Then there is another business that exists between the France and Australian, right? So in this case, we have been told, let us do our interpretation for 4 months. Forward exchange rates, right? A 4 months forward exchange rate. The examiner can see very well that he has given you, the examiner has given you there amounts totaling to 395,000 ASD. And in this case, we are being given the exchange rate there, right, for the ASD, and we are being given the 4-month exchange rate, 1.9510 to 1.9540, right? But nikiangalia currency yangu pale juu imepangwa namna hii, euro per ASD. So unajiuliza vizuri, hii biashara inaendelea ni aina gani? Inamaanisha Jackie Limited is going to be, they have a receipt because wame invoice. Uki-invoice inamaanisha ni pesa unatarajia is a receipt, na they are expecting to receive 395,000 ASD, 365,000 ASD, right? Now in this case, I just want us to define the role of the bank, and we are saying for receipts, bank buys. Why don't you angalia the exchange rate given? 1.59510, right? Now, in this case, you can see our own currency niko hapo. Nisema ikiwa hapa, unafanya tuka mkono namna hii. This is buy and this is sell, right? That is buy and that is sell. So in this case, it means I'm just going to be identifying like my currency, the exchange rate like this. It will be 1.9 because the bank will be always buying. When we have a receipt, the bank buys. How am I going to be identify the buy? I have said currency ikiwa huku, then this becomes buy, this becomes sell. Ikienda on the other side, this becomes buy, this becomes sell. This is a criteria that you need to do some cramming a bit. Now, in this case, we are talking 1.9510 euro is equivalent to 1 ASD. Ask yourself, what about 395,000 ASD, right? Once you cross multiply, just like doing this, right, times 395,000. How many, because this ASD goes with that one, right? How many euros do you have? So in this case, I just do my multiplication, 395,000, I multiply by 1.9510. I'm getting 770. 645 euros. Hiyo ndio pesa Jackie Limited will be able to receive under the two contracts within the 3 and 4 months forward exchange rates. You can see that because you can see the first one, the 3 months, you are able to do the margin principle. The second one is a receipt that we are expecting to receive from a customer. Now, if we don't have a question, we can look on another illustration of a forward. Don't ask me about the money market in Nitakufunza baadaye. Let us go back to do another question. I think two questions regarding to forward contract before we shift our gears. So when I look on May 2019, question 4. May 2014 or 2019, sorry. May 2019. Wanchiro will be able to read for us tonight. Tabitha. Let's go on. Hello. Anyone who can read for us, please? Maureen, can you read for me?
Okay. We read, Kazenga Limited is a Kenyan company with a substantial proportion of its trade with companies in the United States. Kazenga Limited invoiced a US firm $60,000 United States dollars receivable 3 months from now. Additional information, the borrowing rate is 3% above the bank base rate, while the investing rate is 2% below the bank base rate. These rates apply both in Kenya and the United States. The bank-based rates in Kenya and the US are 15% and 10% per annum, respectively. 3. The exchange rates in the forex market between the Kenyan shilling and the United States dollar are as follows. We have Kenya shilling into $1 US, spot exchange rate 103 to 105, 1 month forward rate 102 to 103, 3 months forward rate 101 to 102. Required, calculate the amount to be received by Kazenga Limited using forward contract hedge. 2, money market hedge. 3, using the results obtained in A1 and A2 above, advise the management of Kazenga Limited on the best hedging strategy.
Very good. Now, when you look on this question on how it is being drafted, I think I can be able to do another 2 concepts because they go hand in hand. So in this case, when I look on the question that we're analyzing here, I can see you have already been told that the company that you are doing the analysis is based in Kenya. And from that analysis, you can see the examiner is talking of, the examiner is telling us that, the examiner is able to tell us that the Kazenga Limited has just invoiced the US firm $60,000 US receivable in 3 months' time. So it means there is a receipt that we are expecting to receive. So we have said already, when you define the role of the bank, we have said that for receipts, the bank will always do what? For receipts, what will the bank do? Someone?
Will buy.
The bank will always buy goods. And for the other one? For payment?
It will sell.
The bank,
it will sell.
for payment, the bank will always sell. Very good. Now, in this concept, because already you know what you are dealing with, I can see note number 3, additional information. The examiner is trying to confuse you. Why? He has given you a 1 month forward rate and also a 3-month forward rate. So ukiwa pale na pressure exam, you use the 1-month forward rate, you fail. Because the contract that we have entered with the US firm is for 3 months from now. So because already you understand that, let us do the forward contract. Let us go to our board now. Let's go to our board. And in this case, because we are analyzing our question, I just want to reiterate by writing the roles of the bank. Right? One, we have said that for receipts, bank will always buy, right? And we have said for payments, number 2, for payments, bank always sell. Usiwahi sahau hii when you are doing your money market, when you are doing a forward contract. Now, from this aspect, let us look on what is given here by this examiner. The examiner has told us that we are going to be receiving, there is a receipt, right? A receipt was 6,000 US dollar, right? But in this case, the examiner has also given me the exchange rates. So the examiner has given me the exchange rates on 3 months of forward contracts, 3 months forward contract, forward exchange rate. Let me use like that. So examiner pale amenipea 101, is it 101? Right? To 102, akaniambia Kenya shillings ziko hapo per US dollar. Per US dollar. So tunauliza, where is our own currency? Tuliambiwa ni Kenya. So it means ukifanya kama mkono hivi, hapa becomes buy na hapa becomes sell. Where the home currency? You can see we are discussing about Kenya shillings. Now in this case, because already you know, these are receipts we are receiving. We are receiving 60,000 US dollar, and we have said for receipt, bank always buy. So tutanunua at how much? 101 Kenya shillings is equivalent to 1 US dollar. What about 60,000 here? US dollars. So it means I just take 101, I multiply by 60,000, divide by 1. How much is this? I'm getting Kenya shillings. 60. Right? We are getting 60,000. That is how you do forward contract. They are very simple. Then from there, we do the money market now, because also the money market has its own analysis. So let us do the money market. And we are going also to be analyzing one concept here, which is not different from what we have already tackled. It is not that much difficult. So the most aspect here, let us look on the rules of money market. What are some of the rules of the money market? This is easy utakram tu kidogo. Number 1, we talk about for foreign, right? FRBF. So we are talking about foreign receipts, right? Borrow foreign. Foreign receipts, borrow foreign. So in this case, we ask what is the role of the bank? Bank buys. Then number 2, right? Number 2, we talk about FP, right? BL. We talk about for foreign payments. For foreign payments, you are going to be borrowing local. I will be able to interpret this. So what is the role of the bank? Bank sells. And this concept is very simple in this aspect. When I look and analyzes the foreign, right? For foreign boyfriend, right? For foreign boyfriend, that boyfriend will always buy stuff. And you can see that is a concept here. But from that area, we have to be analyzing the concept, because for foreign receipts, right? For foreign receipts, because now if I'm the person who is going to be receiving a foreign receipt, then it means because I'm entering into contract with the bank, I'm going to be borrowing under the foreign currency. So in this case, because I have borrowed, for instance, 10 million US dollar, when I take them to the bank will always buy my currency. Now, for foreign payments, right? Me na daiwa na Uganda, I'm going to be borrowing local, take my currency to the bank, and the bank will always sell. Bank itaniuzia ile currency ya Uganda. So the bank will sell. But when we look on the foreign receipts, now foreign receipt, nataka kupokea pesa ya majuu, then I'm going to be borrowing foreign because I'm entering into a contract. Remember, maybe we are discussing about the 3 months contracts, 3 months or 4 months contract. So remember, you normally ask yourself, if I'm going to be receiving this money in 3 months' time, how much am I supposed to be pocketing now? That is why we normally say, because now I'm entering into a contract. Mimi naweza enda kwa bank, I borrow dollars because I'm entering a contract with the US dollar. Then the bank, nikishapata zile dollar, bank ndio in exchange to use under my local currency. Then the bank will always buy my currency that I've already exchanged, in my local banks. Now, from that analysis, I just want us to do the money market part, which is part 2. And one of the key aspects in this question, I can see the examiner is giving me 2 concepts, because we have already talked about borrowing, borrow foreign, borrow local, and also investing. So in this case, there is a concept of analysis in the question. And how am I going to be analyzing my question? It looks like this. In not additional information, number 1, I have been told the borrowing rate is 3% above the bank base rate, while the investing rate is 2% below the bank base rate. This rate applies both in Kenya and the United States. This is what you do. Let us come with the countries. Tuko na Kenya, and then hapo kuna USA, right? Hapa tuko na base rate, right? Then utakuwa na lending, right? Lending rates. And then here we are discussing about borrowing. So examiner hapa ametuambia vizuri sana. The borrowing rate is 3% above the bank base rates. So what is the bank base rates? In note number 2, you have been told the bank base rate in Kenya and the USA is 15 and 10. So here we talk about 15% and 10%. In the concept right, and I will be able to show you why are we considering the percentages or the rates, whereas we are doing the money market and they understand the concept of the borrowing and buying. That is not the issue. But when you look on the lending, because when you look on the investing, the examiner is talking about 2%, right? There is a deduction of 2%. So in this case, it means just deduct 2% here. And also when you go to the borrowing, you add 3% to your base rates. Now, in this case, if you take 15 minus 2, right, you get 13%. And if, for instance, we are borrowing, we are going to be borrowing at 18%. Like what you can see the Hustler Fund is all about. Now, here it will be 8%, and also here it will be 13%. Borrowing rates are always expensive than investments. Na hiyo ni kitu unapaswa hata ukienda bank will be able to analyze that. The borrowing rates are always high compared to the lending rates. Now, in order to solve our question here, mimi nataka tuchore ka table namna hii, so that it will be able to assist us in the analysis. Ka table kama kanakaa namna hii. Na pesa yote najua, hata ukipea nani, hata ukipea Victor pesa, anaikanga chini ya table. So, the first thing that you need to be analyzing from our concepts here, the role of the money market. Remember, we are dealing with the receipts, and we have said we are going to be borrowing foreign. So for receipts, borrow foreign, the bank will always buy. And in this case, because we want to know one thing, here we are going to be putting the borrowing to borrow, right? We normally convert Pesa yako now you normally convert at spot. We convert at spot, then you invest at your local currency. Hata hii ni glitch nimekupea hapo, unasema let us invest at Kenya shillings. So it means you are going to be borrowing at the foreign. That is why we say borrow at your foreign. So how much are we supposed to be borrowing? Remember the receipts. Receipts zote unaikanga hapa chini ya meza hapa. Right? So here we are talking about US dollar 60,000. Nimekuambia uko unazieka hapo. Right? You are making a receipt there. And in this case, sisi tunataka tusonge hivi. This is a future. This is a future. Remember kale ka formula ulikuwa unasema the future value is equal to the present value 1 plus R. Haka na juli kamata vizuri sana when you are doing the time value for money. So the truth is, hii ndio tu concept tutatumia hapa kwa money market. Hii, right? Because this is what we are doing. Remember, this is a future value. That is your future value. We just want to determine if I just wanted to borrow now, naweza kopa pesa ngapi? What is our present value? It means I have to get our present value, I have to divide the future value with our discounting factor. So we are discussing about 1 plus the rate of borrowing. Tuna borrow at which currency? Hata ukiangalia hapa nimesema you borrow at your foreign currency, which is US dollar, right? Which we are discussing about the US dollar. So unakuja hapa hata kwa hii chart yako una analyze. I'm borrowing at 13%. So the rate becomes 0.13. But don't forget 13% is per annum. But wewe unafanya contract ya miaka ngapi? 3 months. 3/12. 3/12. So you calculate this first before you add one. Because the interest rate is for only 3 months. The interest rate is for only 3 months. Now, in that case, because I know you are following, you just say 0.13 times 3, you divide by 12, then you add 1. So the discount factor of ours becomes 1.0325. Now, because already this you have, ili uko nayo, wewe unataka kudetermine the present value. So what are you going to be doing? You divide both sides by 1 plus R. Here you divide by 1 plus R. It means I have to be taking my 60 million to determine the present value by dividing by the discount factor. So I just say, let me take 60,000, divide by answer, getting 58. If I just wanted to borrow today, it'll borrow 58,111 US dollars. Is it US dollars? It should be dollars, yes. It should be dollars, not euros. These are dollars. Let me not confuse you. So these are dollars, right? Those are dollars now. Now from there, we are going to be converting our spots. The examiner has given us a spot exchange rates. Examiner amekupea kitu inakaa namna hii. 103 to 105 Kenya shillings per USD. US dollar. Per US dollar, right? Now in this case, you have to be determining the role of the bank. We say the bank buys. And in this case, we say, kama currency ya home hiko hapa, this is buy and this is sell. So, unajua vizuri, ita convert at spot. Unajua ita convert na 103, hata unaiandika hapa. Examiner understands, you say 103 Kenya shillings per US dollar. US dollar. Per US dollar. And because you have dollars and dollars, don't multiply, by the way. If you have the same currency, ukimultiply utakuwa na that currency spared. Unaona? Rahisi sana. Ukishaandika hapa, unajua kama nikichukua ni multiply na hii, itakuwa na that currency spared. But because you want to eliminate the one currency to get the other, now you have to do what? You have to multiply, because you can see if this was in Kenya, if this was dollar and this was Kenya shillings, you need to divide, you see. But now I'm talking about if they were the same currencies, hapa dollar na hapa dollar, yes, dollar and dollar, then you are going to be forming dollar squared. Now in our case here, it's just like saying 103, this is very simple. It's just like saying 103 Kenya shillings is equivalent to $1 US. What about 58,111 US dollars? How much is this? So I just multiply from my calculator. I multiply by I multiply by 103. So kama leo nimepewa pesa yangu, in the beginning of the contract, I'm going to be given 59,85,472. Right? Wewe unataka tu kupata the future value because pesa yetu tutaipata after 3 months. Contract yetu ni ya 3 months, right? So in this case it means, hapa wacha nikwambie vitu rahisi. Ukipanda hapa namna hii, when you are going up, you divide. When you are going down, you multiply. Never forget that concept. When you are going up, divide. When you are coming down, multiply, right? So in this case, because now I'm investing in Kenya, nakuja hapa naangalia, in Kenya, we are investing at which rates? We are investing at which rate in Kenya? At 13%. It's just a coincidence. This 13% is what we're investing. We borrowed at 13% in USA because we were borrowing foreign. Then we are going to be investing in, at 13%. You do the same. You say 1 plus 0.13 times 3 over 12. 3 over 12. You do the same. So it means you are going to be getting, your answer will be similar to 1.0325. You multiply because we are going downward. So you take your present value, multiply with your discount rate to get the future value. So I just take my answer, then I multiply by 1.0325. Getting Kenya shillings. Kenya shillings. Kenya shillings. We are getting how much? Kenya shillings. 61,80,000. 61,80,000. Unajua kuna swali examiner anaulizanga rahisi sana pale. Number 3. Which is our best hedging strategy? Na kuanga rahisi sana. Examiner shakuuliza hiyo swali. Which is our best hedging strategy? Unakujanga hapo unafanya summary. Right? Unasema wakati nilikuwa natumia forward contract. The forward contract tulipata pesa ngapi? The forward contract tulipata Kenya shillings 60. Wakati nilienda nikatumia future contracts, which is the money market, how much nilipokea? Nilipokea 61,80,000. Right? Nitakuwa na kuandikia hapa kidogo na kuambia for receipts. Because najua hata sasa kuna shida ya pesa, but for receipts, take the highest value. Because unataka kupokea more. For receipts, take the highest value. And in this case, you say money market. Namwambia tu vizuri. Money market is the best. The money market is the best hedging strategy. The money market is the best hedging strategy. The money market is the best hedging strategy. Any question? Nimechukua money market because you can see inanipea pesa mingi. I'm dealing with receipts. Zingekuwa payment na zinakaa namna hii, ningesema the forward because I'm going to be paying less. You see? So, always factor the two. Wakati na deal na receipts, take the highest value. When you are dealing with the payments, take the least value. Take the least value. I want to do another question there. I just want to do another question. There was a question which was tested. There is a question which was tested on there is another question in May 2021, the one that I'm looking at. May 2021, question 1C. So who is going to read for us? Let me look on Eric Oginga. Be able to read for us tonight. So let me look for the question first. So Eric, go on. The question is 1C.
Good evening. Dafina Limited is an import firm based in Kenya. On August 2020, the company exported tea to the United States of America, USA, on a 3-month credit amounting to $10 million. Additional information: the rates in the forex and money markets were as follows. On 1st August 2020, Kenya shillings to $1 was 105. On December 1st, 2020, the rate was Kenya shillings to $1 at 101. The interest rate for Kenya is 18% and USA is 12% per annum. The customer will settle the amount on 1st December 2020. I can't see the next page. You are required to do the following. Number one, using the interest rate and the experiment forward exchange rate as at 1st December 2020. And number two, using suitable computation advice Dafina Limited on the better hedging strategy between a forward market and a money market hedge, a total of 6 months.
Very good, very good. I can see that we are yet to reach on parity measures. What we are going to be factoring right now, it is the use of doing the second requirement where the examiner is asking us to do the money and the forward exchange rate. And in this case, the most important aspect is analyzing what we are dealing with. They have been told that Dafina Limited is an export-import and is based in Kenya. And I can see based on that concept, we have been told that the company exported tea to the United States of America on 3-month credit amounted to $10 million, right? And in this case, we have been told very well that the rates which are being given for forex and money market were as follows. We are being given on 1st December, 1st August 2020 is 105, but we are being given on 1st December 2020 is 101. Remember, we are under the 3-month credit period. Credit amounted to, we are under 3-month contract. And in this case, we have to be asking ourselves, are we going to be hedging between which the exchange rate are we going to be using between 105 and 101? The 105 is the beginning of the contract, right? But we are dealing with 101 at the end of the period. In this case, what are we going to be getting? The $10 million. Is it a receipt or payment? I just say this one is a payment. So how am I going to be dealing with this case? This is what you normally do, right? This is what you normally do. You say, I'm going to be receiving our receipts. Our receipts, we have been told it is 10 million USD, US dollars, right? Those are the amount that you're going to be receiving. So how long am I going to be entering into the contract? We have discussed about the 3 months forward exchange rates. The 3-month forward exchange rates. Now, in this case, examiner amekupea rate ya December na rate ya August. So wewe ukiangalia tunatumia rate gani? Tunatumia rate ya December. Kwa nini tunasema December? Najua watu wengi wana count August, September, October, November, right? But we are talking about, when you look on the question down there, the examiner is saying that we are on a 3-month forward exchange rate, right? So the rates which are basically given there, you are not going to be counting the December. So what are we going to be discussing about? Between the 105 and 101, we are going to be using 101, right? We are going to be using 101, right? When I look on that currency, now it is being written, examiner ameniambia Kenya shillings per US dollar. So it means it is just 101 Kenya shillings, which is equivalent to $1. You ask yourself, what about the 10 million US dollars? You just cross multiply and we are going to be getting 101 times 10 million, getting 10 million. 10 million Kenya shillings. 10 million Kenya shillings. 10 million Kenya shillings. That is how simple the forward exchange rate is all about. But what about the money market now. Let us look on the money market. So sisi kwa money market, we said we normally use only two rules. One, foreign boyfriend borrows foreign, sorry. So we said the bank will always buy, bank buys. Then we said for foreign payments, borrow local. And we said bank sells. Bank sells. And in this case, it means let us use our table very well. Let us use our table very well. In this case, we are talking about, I have said here, let me draw it here, up here, so that you can be able to have enough space. So we said, so here on this side, we borrow foreign. So foreign yetu ni gani? US dollar. We convert at spot now. So to convert at now, kama tuna convert leo. So that is the difference between the forward and the future contracts. So we convert now. The rate is 105 at the beginning of the period. Kenya shillings per US dollar. That is completed. This is very simple. Then you are going to be investing at the local currency. Currency yetu ni Kenya shillings. So unajiuliza, hii pesa yetu, which is 10 million now, which is our receipts, tutaiweka wapi? Tulisema kama ni receipts, unaweka hapo, unasema the future value is equals to 10 million US dollar. Tulisema tukipanda namna hii, to determine my present value, right? I'm going to be dividing. So let us look on the interest exchange rate given there. We have been given for Kenya and the USA. So remember, you are dealing with the USA, and this is what you are going to be looking at. Remember now your contract, or the contract that you are entering into, is for 4 months, by the way. It is a 4-month contract, because already you can see the customer will be able to settle the amount on 1st December 2020. Sindio? For 2020. So it means we are dealing with 4 months. August, September, October, November. Those are 4 months. So I just say 4/12 times 4/12. We multiply by the rate of borrowing in USA, which is 12%. We do this, then we add 1. So how much are we getting there? How much am I getting there? So it will be 12. Is that equivalent to 0.04? Yes. So if you take 1, right, 1 plus 0.04, I'm going to be getting 1.04. 1.04. So determine the present value. You just take 10 million, you divide by 1.04 to determine the present value. Your present value will be 9615. 385. This is US dollars. Those are the US dollars. Can you be able to convert at spot to the current currency, to our local currency? Yes, we can convert by multiplying, because this one and this one cancels, right? So I just take my answer, I multiply by 105. And then the currency, the Kenyan currency amount we are going to be having, Kenya shillings, I think is 1 billion. 1009 615 385. 385. We said when you are going down, we multiply. What are we multiplying? We are going to be looking on the investing, and you can see the examiner here. Because we are investing in Kenya, the rate is given is 18%. So I just say 18% times 4/12 plus 1. Plus 1. So it will be 4 divided by 12 times 0.18 plus 1. Then we multiply by 1009 615, right? 385. Sorry, it will be 1009. I have not even written the answer there. So it will be 0.18 times 4 divided by 12 plus 1. This is equivalent to 1.06. Then we multiply it by 1009, 1009, 615, right? 385. Here we are getting Kenya shillings. The future value that we are supposed to be receiving in December, it will be 1070, 192, 308. 1070, 192, right? 1070, 192, 308, 308. Now in this case, because the examiner is asking you to compare between the two, just do your summary here. You will be able to analyze which is the best hedging strategy. So in this case, you say number one, forward contract is able to give us how much? The forward contract is going to be giving us Kenya shillings, 10 million. But when you look on the money market now is going to be giving you Kenya shillings, 1070, 192, 308. We said when you are dealing with the receipts, take the highest value, and we can just advise the examiner that money market is the best hedging strategy. It is the best hedging strategy. The best hedging strategy. Any question? Any question? Any question? Any question? So to do an assignment, because you have to be doing assignments, go and do May 2017. That question you are doing. I think should be question 5C. Ile swali tulifanya kwanza, just do the money markets, the money market part. And let me see what you have already done. There should be question 5B. So go there, do the money market parts for both the 3 and 4 months and see how you will be able to interpret the question. Then when we meet next, we are going to be looking at 2 things here. I'm going to be looking on the theories. I'm going to be looking on the theories of foreign exchange. The theories of foreign exchange. Here, we normally analyze only, there are always 3. We are talking about purchasing power parity. Purchasing power parity. PPP. Right? Those are the purchasing power parity. Then number 2, we are going to be analyzing about, we're going to be looking on the international Fisher's effects. International Fisher's effects. And also we are going to be checking on the interest rate parity. Interest rate parity. We are going to be analyzing the 3. After that, I'm going to be looking what normally cause the interest rate fluctuations. Then thereafter, I will be able to shift my gears. I do options. Na tutakuwa tumemalizana na hii kitu, tutakuwa tumemalizana na this problem. Any question? Any question? If we don't have any question, let us stop at that point. Let me see you, not tomorrow. We shall conclude on Sunday. Tomorrow will not be available. We shall be able to conclude on Sunday evening. Shatoka church, shatoka shughuli zetu. I will be able to do the class majioni too. We can start from 5, or we shall be able to arrange through our WhatsApp group. If we don't have any activity for tonight, we can stop at that point and see you over the weekend. Thank you. Good night.
Good night.